A CoreWeave stock, ticker symbol CRWV, just reported earnings. They are down 5% after having a little bit of a rally to the $75 mark. They have paired all of those gains and then some. However, net, we are still flat on the day. So we're going to talk about CoreWeave, their earnings. Was it good? Was it bad? And what does this mean for the AI outlook looking forward? Let's dive in. But before we do that, could you please go ahead and subscribe? It really helps me out. Now, CoreWeave reported very mixed earnings. Now, revenue is growing like a weed, up 421%, reporting $981 million, just under $1 billion, smashing analyst expectations. However, earnings was not that great. The analysts were expecting negative 12 cents. Management reported negative 60 cents. So it does go to show that expenses are piling up. And we're going to talk about what expenses specifically. And when it came to guidance, it was also very mixed. The company reported 1 to 1.1 billion. This is for the second quarter. Some people say that's in line. My data had it as a miss, a slight miss. And then adjusted operating income was guided for in line at $140 to $170 million year over year. Looking at some of the headlines, you could see that gross margins went actually the opposite way. The company had 74% gross margins last quarter. This quarter, they had negative 1.1%. That's because the company reported a loss in the quarter, at least relative to the operating expenses. However, when you look at their adjusted EBITDA, this is the main figure that they talk about. We saw margins expand from 55 to 62%. And on a nominal basis, you're looking at about 104 million to about 106 million. So the revenue growth really seeing an uptick here. However, this adjusted EBITDA figure is very skeptical, and I wouldn't pay close attention to it as such, but it's a good tool for valuation nonetheless. The adjusted net income margin increased from negative 12 to negative 15%. And again, that has to do with some of the expenses they accrued, and losses went from negative 23 million to negative 149 million. And that is why we saw a negative 60 cents in earnings per share print. So while the business looks very healthy on an EBITDA basis, on an adjusted EBITDA basis, once you include all of these other expenses in, the business is still losing money on a year-to-year basis. The company is also laden with debt, having $10 billion in debt and only $1.3 billion in cash. And they are expected to increase this significantly because the management team gave us their guidance figures for Q2 and the full year. And I think a big reason as to why the stock was down was actually this right here, the capital expenditures, right? The company came out and said for the full year, they're looking at $20 to $23 billion in capital expenditure. So they're going to take on a lot of debt. They are probably also going to dilute their shareholders because they're probably going to need to capital raise to get some of this funding as to not blow out their balance sheet. Nonetheless, the company is guiding for about $5 billion at the midpoint in revenue for the full year, and adjusted operating income of 800 to 830 million. And then with these capital expenditures, you can believe free cash flow is going to look like a dumpster fire. For Q2, we went over the revenue and adjusted operating income. They're looking at interest expense of about 200 to 300 million. Now, guys, think about that, right? Q2, that's a single quarter. Their interest expense is nearly 300 million, when adjusted operating income for the full year is going to be 800 million. So interest expense will be a massive component for this company in terms of their expenses moving forward. And that is why EBITDA is not actually a great metric to value this company, because that is a tangible expense. Interest expense is a massive expense for this company, and valuing a company, before its interest, tax, depreciation, and amortization is not really fair. But for loss-making companies, you can give them a pass as per se, and then they're looking at $3 to $3.5 billion in capital expenditures. However, one thing that's good to take away is that the business still sees robust AI demand, and that is why they're plowing a ton of money into capital expenditures. Now, on the earnings call, the biggest thing, in my opinion, was actually this figure right here. The revenue backlog for CoreWeave is 25.9 billion. So you can actually go ahead and say that this capital expenditure figure is justified because CoreWeave as a whole is still capacity constrained. However, take this number with a slight grain of salt because $11.2 billion of that revenue backlog was for OpenAI, or essentially Microsoft. And that has been a big issue with this company. Meta and Microsoft and some of the hyperscalers are the biggest partners of CoreWeave, and they have the revenue is really concentrated in those hyperscaler names. Now, this is where CoreWeave's data centers are. So they have most of the data centers in the US. They have 5 data centers in Europe, 33 data centers in total. That is the active power and 1.6 gigawatt contracted power, which equates to roughly, I would say, about 500,000 NVIDIA GPUs, somewhere around there. And you can see they have data centers all across the board to service hyperscalers wherever they are, both in the United States and Europe. And this is why CoreWeave is a key partner for these hyperscalers, because the majority of the revenues come from the United States and Europe. And so to have a partner like CoreWeave internationally diversified, it's something they can rely on. Very, very interesting. They have 33 data centers and they're probably going to double their capacity in the next year or two. So this is definitely a growth name, but not just a company growing from like 100 million to $1 billion. This is a company that's set to grow its revenues from about $5 billion this year to close to $25 billion by 2029. And according to the management team, AI demand is still very, very robust and they are still capacity constrained. Looking at the financials, you can see revenue grew 421% from 188 million to nearly $1 billion in the 3 months up to March 31st. Operating expenses increased $487, and that is why earnings per share was actually negative, because you could see right here that revenue came in at 981 million, but operating expenses was above $1 billion. Now, a massive change in the company's financials is interest expense increasing 549% from $40 million per quarter to about $250 million. And that is why you actually see net losses increase 143%, guys. That is a net loss. You want to see this going the other way. You actually want to see net losses decreasing. That is simply not the case. And that is how we get diluted earnings per share net loss of $1.49. This is the unadjusted figure. However, when you look at the adjusted figures, adjusted EBITDA, margins expanded, and the company said they did $606 million. However, this adjusted figure is very, very skeptical. It excludes stock-based compensation, depreciation, amortization, interest expense, taxation, and a whole range of other stuff. And I just don't think it's super accurate to get a true value of the company. Nonetheless, that metric is there. Adjusted operating income expanded and net loss went from 12% to 15%. Now, if you are a shareholder of CoreWeave or looking to become a shareholder, now the biggest thing you want to watch is the customer concentration and growth as it pertains to the AI trade. You want to be keeping your eye on all of the big names in the AI space. And if they continue to see robust performance, if they continue to increase their capital expenditures, then the stock will do very, very well. You also want to look at CoreWeave's capital expenditures, and you want to watch how they balance CapEx with profitability to avoid cash burn, dilution, and excessively bloating their balance sheet. And I think one of the biggest things you actually want to watch in this environment is supply chain and infrastructure resilience. CoreWeave's growth depends on securing GPUs and data center capacity. Supply chain disruptions or partner issues could hinder scalability, particularly in 2025. So those are the major things you want to look for if you want to get into the name. I think CoreWeave right now, their moat is still being built. It's yet to be determined if they do have a competitive advantage against the other data center providers, and the thesis is still in the works. Now, looking at the valuation of the company on an EV to EBITDA basis, the company is looking fairly attractive. However, on a shareholder yield, it is still at negative 20%, however, moving in the right direction. So you as a shareholder are being diluted with debt as well as capital capital raises and overall net losses. However, when you do look ahead, particularly 5 years, the company does appear to be attractive, and that just really goes to show their growth profile. I mean, if the company can sustain the consensus estimates for growth, which is actually for about 30% growth every single year sequentially to 2029, if the company can sustain that, the stock does look cheap. So we're going to use consensus revenue growth figures and adjusted EBITDA margin of 62%. And so by 2029, we're getting adjusted EBITDA of 11.9 billion. That's the current EV to EBITDA. We're going to use a 10 times multiple, which is cheap just because this adjusted figure is a bit sus. So we're building a bit of safety through the multiple. Now we're going to assume the company has $35 billion in net debt. Then we get the enterprise value and the equity value divided by shares outstanding. Now I'm expecting shares to dilute at about 10% every single year, and the share count should almost double from where we are right now to 2029. So there's a lot of share dilution, and even then the stock price in 2029 can be $155 according to this valuation model. Current stock price is 67. That would represent an 18% compounded annual growth rate. And then if you discount this figure back by 15%, you get a fair value estimate of $77. The company trades at $67, and that's probably telling you that the stock is undervalued, relatively speaking. Very interesting, something I did not expect, but it's all dependent on this growth. If they can hit these growth measures, the stock is cheap. If they can not dilute shareholders as much, the stock is even cheaper. Very interesting. I wasn't expecting that. I was expecting an egregious valuation. That is simply not the case, and it does go to show that growth solves all issues in this business. On the technical charts, there's not much to look here. The stock has only been trading for a couple of weeks. It's had ups, it's had downs. From the bottom here around the $35 area, it's doubled since the tariff lows, actually retaking these highs. And I think the stock's probably going to go higher. I think on the back of these earnings as well as the guidance we were given, I think that they're going to move higher despite what we're seeing in the pre-market. I actually thought this report was actually really, really good. And it does show that the company is still capacity constrained. And if that is the case, we can definitely see those revenue growth figures being hit. And in fact, if they bring more capacity online, you can see upside to those figures. However, you will be pulling forward some of that demand. So is CoreWeave a buy right now? I would say yes. Just a very, very small part of your portfolio. This would be a great company to just, add in there and let it do its thing. Make it 1% or 2% of your portfolio, nothing major, and sort of have it grow to like a 5, 6, 7% position. And, maybe keep a tight stop at maybe like $40, maybe $35 at these lows. You can keep a tight stop. Maybe you could sell some puts at the $50 range, maybe the $60 range if the stock does get back, and then you could buy at these levels. But I would say that CoreWeave probably is a buy right now. However, keep it small, keep it tight, and manage your risk effectively. However, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.